Hey everybody, welcome back to AWM Insights. As you know, each week we cut through the noise of what Wall Street is trying to sell you to bring you the knowledge, skills, and access that you need to invest like a pro. And today we're going to tackle a really interesting topic. We've hit on it before, but we continue to see it show up. But how do we actually go about, or should we go about, predicting the markets? Spoiler alert, you shouldn't. But before we get into that, Justin, let's hit on some of the stuff in the news.
Sure. Well, congrats to the Braves, man. That was
Absolutely
a well-earned win there, and we've got quite a few guys there. So hey, it's a good day. Good day for all around. On the unemployment front, so some economic data. October payrolls grew by 531,000. Very, very good number. The expectation was somewhere around 400,000. So a lot better than what was expected by the market. Unemployment is now down to 4.6%, shaved off, I think, 0.2% there. And overall, kind of widespread, strong, really good looking data. Now, I will caution, and I think I've said this time and time again, these numbers are noisy. They bounce around quite a bit, but this was certainly a good data point to see from an economic standpoint. Other economic measures are showing a little bit of momentum loss, which is somewhat expected as you kind of think about, we bounce off the bottom, the COVID shutdown bottom, the economic destruction and whatnot that happened there. We bounce off the bottom, and it's only natural for some of that momentum to start to give up. But something to pay attention to. As a result, that the economic data is strengthening, or is strong rather, and starting to plateau a little bit. Central banks feel somewhat confident enough to start to pull back on the stimulus that they've had into the system for, quite some time, year and a half or so. They call this normalizing policy. You might see that in the news quite a bit. Still are not anywhere near increasing interest rates. So these are other tools that they have in the system to support it. But expect interest rates to be a big topic of conversation over the next couple months, couple quarters, and we'll see where that goes. And then getting into kind of leading into the topic at hand here, it's earnings season. Earnings have been very strong for the most part, but there's been some tech darlings and pandemic darlings that have gone against that trend. So Peloton being a great example of this, that stock was really, really hit after they released earnings, down something like 30% as a result of really their forward-looking guidance. So when a company releases earnings, they say, hey, this is what's happened in the last quarter. Here's our revenue. Here's our bottom line profit. And they give plenty more context. But those are the big things that market participants look for. And then they say, hey, this is what we expect going forward. And analysts can poke and prod and whatnot. And Peloton's really basically said, hey, what we expected going forward just as early as a quarter ago is no longer what we expect now. And the market took that information and immediately put it into the price of the stock and reset their expectations. And the stock is down quite a bit. Additionally, on this topic as well, and we'll get into this more, but Zillow all of a sudden did a 180 and is now out of the house flipping business. So maybe not everyone knows about, 3 years ago, 2018, Zillow said, hey, we're going to get into the house flipping business. We're going to buy houses, improve them, flip them, hold them for approximately 90 days, and then flip them and make a profit. And fast forward to today, they're basically saying, hey, that's really, really hard to do, and we don't want to participate in that any longer. We actually can't predict how the market's going to move like we thought we could, even though they have, just reams and reams of data. So again, kind of going towards the topic at hand today, both of those items, and we'll dig into that a little bit more. Yeah, no,
I think that's a great intro there, Justin. I think one thing that, maybe we should have seen the Peloton thing coming. I don't know, the level of dust sitting on my Peloton might have told me. But, in all seriousness, I think these are great examples, too, of a very healthy functioning market, right? Up until the release of that information, which nobody had access to prior to Peloton coming out with that earnings guidance. And if you had and you traded on it, you're looking at pinstripes here and bars pretty soon. But the fact that information came out, like you said, I love the word, immediately, we saw a correction. And that's when we talk about the efficiency of markets, especially the public stock market, is everybody has this same information. And so when we see new information hit the market, it doesn't mean that the price of Peloton stock was wrong yesterday. It means that the introduction of new information allowed the stock to healthily reprice to what it is actually valued at given the new information. And so, when we look at that, we look at Zillow to think about what would have to happen as an individual investor, at a simplest level, or even a fund manager that's staring at all his Bloomberg screens, the quickness with which you would have to act across all these different stocks. It makes it almost impossible to actually predict the market. And who would have known? Who would have known that Zillow all of a sudden, they were hiring something like, I don't know, 100,000 people a month or some crazy number for this home buying division.
Yeah, I think
and then
that's
all of a sudden
25% of their workforce.
Yeah, and all of a sudden they're getting out of it. Like, how do you predict those things? I think the short answer is you can't. It's a lot more fun to try to do it. It's economically very bad decision making, but I think these are great examples for us to riff on a little bit here.
Yeah, and I think the critical point here too to distinguish is public markets versus private markets, or even adding a layer, and you were alluding to this, Brandon, efficient markets versus more inefficient markets, where information is our access to information, let's say, is more asymmetric. I mean, the whole idea of public markets is making it a level playing field as much as possible, and in general that works. Those markets are efficient, and if you're participating in insider trading, you will likely be caught, et cetera, et cetera. We don't need to go down that rabbit hole, but it's a very important distinction, and even at that, it is these individual public companies still have an incredibly difficult time predicting their own future as well. So there's a couple layers here, right? And that's just the world in general, right? I mean, no, I don't know very many people who would say, "Hey, we can confidently predict the future. We're going to diversify our exposure and our allocation of capital for a company that is within their industry." And in this case, Zillow made a wrong call. And they've kind of acknowledged that, but it is interesting to go through, look at some of these quotes in an article I pulled up. But when they launched this, essentially they said, "Hey, why we think we're good at this, and we can actually make money here." It says, "Nobody understands the housing market better than we do. We intend to keep these homes for less than 90 days. We have a lot of predictive capabilities based on our housing data and our consumer insights." And it continues. Fast forward to this week, basically, where they said, "Hey, we're gonna back out of this." It says, "Fundamentally, we have been unable to predict future pricing of homes to a level of accuracy that makes this a safe business to be in." And that's not to say like, "Hey, they screwed up. They made a big mistake here." That's just the nature of the world we live in. And when you're dealing in more efficient markets where information is incorporated into the price and into behavior incredibly fast, it's a difficult thing to predict, versus the private market, where again information is asymmetric. And what I mean by that is from an investor standpoint, you might have access, or we would have access, or we're going to participate in that market where the information we can read, we can glean, is not readily available to everyone necessarily, or there's an interesting value add component that exists because of our area of expertise, because of the athlete, because of the founder network that we exist in. There's just so many more inputs into that calculation that can give an edge, as opposed to the public markets, where again that it's a level playing field. It's very competitive, it's efficient, as we've said time and time again. And this isn't to say that it's all on the downside either. There's plenty of examples where earnings have been released and it it exceeded expectations, and then all of a sudden those prices up 10% the following day. So they go hand in hand. Consistently participating in that in a profitable fashion is where all of this stuff really breaks down in the public markets.
Yeah, no, I think those are fantastic points, Justin. And, I definitely can't let this go. When you were talking about the Zillow piece, what was ringing in my head were all the conversations I have about the realtor that's telling, the person buying the house, 5 years from now, this thing will be worth, a couple $100,000 more than it was. So this is a no-brainer. I think just, again, going back to context, right? And like what you're trying to do, it even goes to a bigger picture. I mean, things could come way out of left field. Penn Gaming crashes because Portnoy goes haywire. Like that's a one guy in a company. Like it's the craziest thing ever, right? So I just think, like you said, which I really appreciate, is it's not all bad. And at the end of the day, the lesson that we're trying to get through is it's just incredibly difficult to isolate these companies and make predictions and do all these things. When we go back to the data, when we simplify things, what we do know is that if we are a long-term investor, somebody that can be patient, we want to bet on the world's economies to continue to grow, right? We get rewarded for that. And so, there is a lot of good that comes out of all of this. It's just not getting distracted by the short term and just participate across the entire world in a very thoughtful, data-driven way. And if you do that, you're going to end up having a lot of success as an investor. Anyways, hope you enjoyed today's show. Took a little bit of a lesson there. We're not out trying to predict things day to day. Stick to that long-term plan. If you enjoyed this, head on over to awminsights.com. We got some free downloads there that might be helpful to you. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.